China is in the midst of its worst economic crisis in decades. The property market, accounting for roughly a quarter of economic activity in China, is facing an oversupply of empty apartments on an inconceivably large scale, meaning that all activity in this industry should but won't cease. The other pillar of China's economic strategy, export-led growth, is also under severe strain because the rest of the world is simply no longer willing to absorb China's glut of manufactured goods. Finally, China is facing a demographic nightmare. Its population is shrinking and is widely expected to contract by at least 1/3 by the end of the century. Government debt will have to skyrocket over the coming decades to prevent China's economy from collapsing into a Great Depression, just as Japanese government debt has since Japan's economic bubble popped in 1990. The grave economic challenges confronting China were discussed in the previous Macro Watch videos. Today's video will discuss the countries, industries, and companies that are most exposed to the end of China's great economic boom. Those doing business in China or selling products to China will find it increasingly difficult to make money there for two reasons. First, China's economy is likely to stop growing altogether, as explained in the last two videos. Second, much of the rest of the world is expected to impose high tariffs on Chinese goods to protect their domestic industries from Chinese dumping. When that happens, China will retaliate by punishing foreign companies doing business in China. The rise of China has been the most important driver of global economic growth this century. The stagnation of China, which could last for decades, is now likely to act as a severe drag on the global economy. Those who benefited the most from China's boom are likely to suffer the most from its bust. Let's look at who the winners were and who the losers are likely to be. In 1990, China imported $54 billion worth of goods from the rest of the world. In 2023, it imported 48 times that much, $2.6 trillion. This Chinese demand drove global economic growth, but Chinese imports are paid for by Chinese exports. China's exports always exceed its imports, as shown here. Exports in purple, imports in yellow. Going forward, however, it looks very likely that China's exports are going to decline. If so, it's certain that China's will import much less too, particularly since the end of China's economic growth and the radical downsizing of property construction there mean that China will require far fewer imports. China's exports grew very rapidly most years between the mid-1980s and 2015. But from 2015 to 2020, exports stopped growing and in some years contracted. From 2021 to 2023, Chinese exports boomed again due to COVID lockdowns and COVID stimulus in the US. But looking ahead, they are likely to fall now that the COVID boom is over. So in 2014, China exported $2.3 trillion worth of goods. That fell to 2.1 in 2016, rebounded to 2.5 in 2019, and then jumped to 3.5 in 2022, and last year was 3.4. But a large decline in exports is likely going forward. China's imports are very likely to decline for three reasons. First, its exports are likely to decline. Second, no growth in China means less demand for imports.